How much did this AI cost?
Just a little.
About 3 countries' GDP.
I'll stick with Excel.
Why is everyone fighting over energy?
Because AI needs electricity. What about humans?
I'm basically an NPC. What happened to the financial market? It's called a zombie fund. Where did all the money go? So GPUs are the real currency.
In the Middle East, a series of maritime blockades has forced a sudden halt to a significant portion of the world's commercial traffic. The escalating conflict acts as a physical barrier to the transit of energy and materials, affecting supply chains far beyond the region. This map shows the flow of critical resources through the Strait of Hormuz. Over a third of the world's fertilizer production relies on this exact shipping lane, which is now functionally blocked. Based on these supply constraints, the UN Food and Agriculture Organization projects global food prices will average 15 to 20% higher in the first half of 2026. These commodity shocks face a specific economic constraint. Central banks cannot lower interest rates while supply-side pressures continue to drive prices higher. This chart tracks the resulting monetary policy. The Fed funds rate holds elevated to combat the sharp upward spike in commodity inflation. The persistence of high borrowing costs turns a localized geopolitical blockade into a global risk for the broader financial system. We can see the primary casualty of this rate environment in this Financial Times investigation into the $22 trillion private credit market. For years, private equity firms have used amend and extend tactics, rolling over bad debt to delay marking down their portfolios. These funds are now carrying overvalued investments on their books that have not yet adjusted to the reality of sustained high interest rates. Heavy investments in software companies and healthcare roll-ups face an imminent repricing. Looking at the data, this line chart compares cumulative default rates. The trajectory for early 2024 arcs upward. These defaults cluster heavily in specific loan vintages originated between 2019 and 2022. This bar chart breaks down distressed borrowers rated CCC to C. The vast majority of the distress stems from loans originated in 2021 and 2022. Investors seeking an exit are hitting a liquidity wall. Funds strictly limit withdrawals, usually capping them at 5% of net assets per quarter. When first quarter numbers are finalized next month, performance that has lagged public benchmarks will be realized as steep markdowns. Private credit currently operates as a highly illiquid trap for allocators. Equities currently lack clear leadership. Investors are actively rotating out of the software companies that previously drove the market. The focus of AI investment is shifting from software layers toward the physical infrastructure required to build them. This cleanroom environment highlights the critical bottleneck for AI hardware, semiconductor manufacturing, which depends on global helium supplies. Fabricating advanced silicon wafers requires constant helium flow to maintain cryogenic stability during the etching process. Demand from chip makers is rising against a fixed global supply of roughly 190 million cubic meters per year. This volumetric cube visualizes that global production. Crucial cryogenic containers, representing a massive portion of this supply, are currently stuck in the Middle East due to the ongoing blockades. Semiconductor manufacturers face immediate surcharges and physical production cutbacks, directly affecting their operating margins. Generating alpha in AI now requires navigating the physical and geopolitical bottlenecks of the hardware stack. Data centers present a second, very real physical constraint on the AI boom: their massive electrical power requirements. This localized surge in power demand has split the utility sector into 2 distinct investment profiles. Independent power producers exposed to data centers have seen large inflows. Constellation Energy is up 3-fold, and Vistra has climbed more than 6-fold. Investors have repriced these specific utilities with high multiples and the volatility that comes with them. Meanwhile, the broader, traditional utility sector remains historically discounted. This bar chart measures the price-to-earnings ratio. The utility sector trades at an average of under 19 times expected earnings, distinctly cheaper than the broader index. Despite the broader market's expansion over the last decade, the sector trades only 4% higher than its own 10-year average. Beyond the discount, large-cap defensive utilities consistently provide dividend yields above 3%. Traditional utilities present a defensive yield opportunity in a market characterized by high valuations. The strategy here relies on rotating capital out of opaque, highly leveraged assets and securing transparent defensive yield. Avoid the illiquid private credit roll-ups before their Q1 marks are finalized next month. This terminal watch list tracks classic defensive utilities to long. Specifically, Consolidated Edison, Southern Company, and Duke Energy. Consolidated Edison is insulated from the current AI data center boom because electricity prices in its New York territory are high enough to deter the build-out of new facilities. This reduces the risk of infrastructure overcrowding affecting its operations. These three companies maintain traditional defensive characteristics while delivering reliable dividend yields above 3%. This combination of traits provides a hedge against sudden AI drawdowns and broad macro volatility. Securing these names provides the defensive positioning required to withstand the current macroeconomic environment. We have immediate corporate data arriving on Tuesday that tests this macro thesis. Unilever is initiating a $16 billion spinoff of its food business to streamline its operations. This flowchart tracks the corporate restructure. Unilever will consolidate its focus on beauty and home care while spinning off the food entity with a $16 billion cash component. Current shareholders will retain roughly 2/3 of the new food entity. On the same day, McCormick reports quarterly earnings, providing a direct check on global food prices and consumer response. McCormick's results will indicate the impact of the fertilizer and transport shocks rippling outward from the Hormuz blockade. Use Tuesday's earnings results and next month's private equity markdowns to time your capital rotation. In an environment defined by geopolitical friction, alpha belongs to those who trade the physical constraints of the real economy.
flickers red, margins in a haze, brains crossing 110, light in the blaze. S&P bleeding, Nikkei in a dive, in a world of volatility, who's gonna survive? From the Strait of Hormuz to the Texas dust, we're building cathedrals and algorithms we trust. Project Mali rising 3,000 acres of power, while Egyptian pounds crumble in the midnight hour. The old moats are shifting, the water's gone cold. It's not about gold bars, it's the grid that you hold. Italy's burning, the yields touch the sky, while the ghosts of the sauce model lay down to die. Welcome to the energy war, the AI heat, where the silicon pulse meets the boots on the street. We're long on the giants, the kings of the flow, and short on the zombies with nowhere to go. The world is vibrating, a systemic crack. Once the embers are burning, there's no turning back. Trump's on the wire, the Cargill threat, a desert of salt where the sun hasn't set. They call it a war crime, we call it a trade. In the shadow of blackouts, the fortunes are made. The bullet trains hauling the freight through the dark, while Blackstone is searching for one single spark. Dividends borrowed on a house made of cards, navigating the ruins through the private fund yards. Owls on the mountain, higher for longer. The hunger for carbon is only getting stronger. Asia's retreating to the dust and the coal, while Hong Kong is fighting for the capital's soul. Zero tax dreams and a liquidity crisis.